Welcome to our Christmas countdown for risk markets. Advent calendars usually hide a small surprise behind each window. We're doing the same for markets. Every day until Christmas, we will open one window on a theme where the consensus may perhaps be wrong. Day one is the global economy. 2 years ago, everyone was braced for recession. It never arrived, and that failed call still haunts many economists. Today, the consensus is much more comfortable, slower growth, but not collapsing economies, mild pressure, but offset by central banks that are willing to ease. In other words, an extended Goldilocks. But the picture is far from uniform. Growth in the developed world is clearly slowing, while economies like India are still powering ahead and China is still tentatively recovering. Even within the US, we're already seeing a two speed economy. The AI ecosystem is booming and somewhat detached from the broader macro trends, while the real economy is feeling a squeeze, you could say. Where could the surprises come from? First, tariffs and deglobalization could quietly erode growth, although they haven't had much of an impact so far. Second, sticky inflation could turn today's soft landing story into tomorrow's stagflation scare. And the biggest swing factor, of course, especially in the US, is capex. If AI investment slows sharply, headline growth could come down much faster than the markets are expecting. The key linchpin, of course, remains the labor market. As long as jobs hold up, the downside is somewhat cushioned. But we see more probability of negative surprises than positive ones. Question is, what do you think? Are we underestimating the downside or the upside? Share your biggest surprise scenario for 2026 and come back tomorrow for day two when we talk about the outlook for interest rates. This is Sunil Garg from Kenai and Lighthouse Canton.